Problem 24 from chapter number 11. This is a more advanced problem with the fact that we need to calculate the cost of each type of financing. The three types of financing or sources of funds are debt, preferred shares, and common shares. We've used all these formulas in previous examples. This is the first time we've used all three of them, or will use all three of them, in one example together to find WACC, weighted average cost of capital. Companies do not get all their funds normally from one source of funds. Rather, they borrow money, which is cost of debt. They raise funds by issuing preferred shares, which is a lot less common. And they issue common shares. Now, also, it's not even just issuing common shares, but also the profits the company makes, because that belongs to the common shareholders, is considered KE, cost of equity. So in previous examples, cost of debt in this particular case is 11%, which is the bond yield, the current bond yield. The tax rate is 30%. So as you should know, the company doesn't pay 11%, they pay 70%. So because they get to write 30% off against taxes. So their real cost of debt, or after-tax cost of debt, is 7.7%. So you use the yield rate, not the coupon rate. The coupon rate is the old interest rate that was from the first day the bond was issued, which in finance is not really relevant. What the bond was issued for at a period in the past is not a big part of finance at all. Now, preferred shares are going to pay a dividend of $10. They're going to be issued for $98, but there will be a flotation cost, which you can consider a commission to the broker or the brokerage company to sell the shares for you. So the company will not get $98. They'll net $92.50. But remember, the person who paid for the share and paid $98 expects a $10 dividend. So the company's cost of preferred shares is 10.81%. Now there's no adjustment for taxes because dividends are not tax deductible. Same thing for cost of equity. The dividend next year is $3. You simply divide that by the current price of the share of $50. You add it to the growth rate. These are all formulas that we've done before, so you should be familiar with this. And you wind up with 14%. Once again, you do not adjust the cost of equity for taxes because dividends, common share dividends, are not tax deductible. Then as we scroll down, you take the after-tax cost, and the only one that's really after tax is debt, because the other two, preferred and common, are not, no tax adjustments. 35% of the money is raised through debt. So you simply take the 7.7%, multiply by 35%, and you wind up with 2.7%. You take 10% for the weight for the preferred shares, and you wind up with a weighted cost of 1.07. 55% of the funds is either going to be through profits or new common shares, although in this case it's all based on profits because there are no new shares. And that will wind up 55% of 14% is 7.7 as a weighted cost. And you then sum those up. So this company will have a weighted average cost of capital, KA, of 11.48%. So when you use an interest rate to discount your cash flows, this company on average would use an interest rate of 11.48%. So they would need to find opportunities to invest that are going to earn them a rate of return above 11.48%. If it's below 11.48%, they should reject. If the rate of return is above 11.48%, they should accept, but you still have to consider in risk If the project is more risky than average or less risky than average, this is just sort of based on average levels of risk. And that's how you would calculate a corporate cost of capital. And they will use that as their discount rates when they are calculating present value of their future cash flows.